In the world of investing, we all dream of striking it rich. We want big returns, and we want them fast. So, when we see a stock boasting a 7% dividend yield, our ears perk up. That's some serious cash flow. But hold on a minute. Before you go chasing those juicy dividends, let's get real. High yields often come with high risks. Remember, if it sounds too good to be true, it probably is. Think of it like this. Would you rather have a reliable car that gets you from point A to point B? Or a flashy sports car that might break down on the side of the road? The same principle applies to investing. A stable company with a modest dividend might not be as exciting, but it's less likely to give you a financial heart attack. Let's take a closer look at 3 companies known for their hefty dividends: AT&T, Valero, and Altria. AT&T, the telecom giant, has been a dividend darling for decades. Valero, the energy powerhouse, has rewarded investors with generous payouts. And then there's Altria, the tobacco titan, known for its controversial but profitable products. These companies might seem like safe bets at first glance. They're established players in their respective industries, but don't let that fool you. Behind those tempting dividends lie risks that could leave your portfolio gasping for air. So, why are we so drawn to high-yield stocks? Simple. We love money. And a 7% dividend yield means a $10,000 investment could generate $700 in annual income. That's money you can use to pay bills, reinvest, or treat yourself to something nice. Plus, dividends can provide a cushion during market downturns. When stock prices are falling, those dividend checks can feel like a lifeline. But here's the catch. Dividends are not guaranteed. If a company's profits take a hit, it might be forced to cut or even eliminate its dividend. Section 4. AT&T, telecom titan, or debt-ridden dinosaur. AT&T is a behemoth in the telecommunications industry. It's got its fingers in everything, from wireless service to cable TV to streaming. But this giant is burdened by a mountain of debt, largely accumulated through acquisitions. To make matters worse, the telecom landscape is fiercely competitive. New technologies and rivals are constantly emerging, putting pressure on AT&T's profits. While AT&T's dividend might seem enticing, investors should be wary. The company's high debt levels and competitive challenges could jeopardize its ability to sustain those payouts in the long run. Section 5. Valero, riding the energy roller coaster. Valero is a major player in the energy sector, refining crude oil into gasoline, diesel, and other products. The company has benefited from rising oil prices in recent years, but the energy market is notoriously volatile. Geopolitical events, natural disasters, and even government regulations can send oil prices soaring or plummeting. Valero's dividend is tied to its profits, which are directly impacted by the ups and downs of the energy market. While the company has a history of paying dividends, investors should be prepared for a bumpy ride. Section 6. Altria, smoking out, profits, inhaling risks. Altria is the company behind Marlboro cigarettes and other tobacco products. Smoking rates are declining in many parts of the world as people become more health conscious. This trend poses a significant challenge to Altria's core business. To adapt, the company has been investing in alternatives like e-cigarettes and smokeless tobacco. However, these new products face their own set of regulatory hurdles and consumer skepticism. Altria's dividend might seem tempting, but investors should consider the ethical implications and long-term risks associated with the tobacco industry. Section 7. The verdict. Are these dividends worth the gamble? High-yield stocks like AT&T, Valero, and Altria can be alluring, but they're not for the faint of heart. Before you jump in, ask yourself, am I comfortable with the risks? Remember, a high dividend yield is often a sign of underlying problems. It's crucial to look beyond the payout and assess the company's financial health, competitive landscape, and long-term prospects. Investing is not about getting rich quick. It's about building wealth gradually over time. So, do your homework, diversify your portfolio, and don't let those big dividends cloud your judgment.